We don't see this as having any implications for the broader economy or for the economic outlook, nor for our ability to control rates. The strains in the money markets reflect forces that we saw coming, and they just had a bigger effect than I think most folks anticipated. Strong demand for cash to purchase treasuries and pay corporate taxes. We took appropriate actions to address those pressures, to keep the Fed funds rate within the target range, and those measures were successful. If we experience another episode of pressures in money markets, we have the tools to address those pressures. We will not hesitate to use them. And since we're talking about this, let me take a step back and say this. Earlier in the year, as you will all recall, after careful study over a period of years, actually, the committee announced the decision to implement monetary policy in an ample reserves regime. And we've been operating in that regime for a full decade. We think it works well to implement our rate decisions. The main hallmark of that regime is that we use adjustments in our administered rates, the IOER and RRP rates, to keep the Fed fund rates in the target range. It's designed specifically so that we do not expect to be conducting frequent open market operations for that purpose. So going forward, we're going to be very closely monitoring market developments and assessing their implications for the appropriate level of reserves. And we're going to be assessing, the question of when it will be appropriate to resume the organic growth of our balance sheet. And I'm sure we'll be revisiting that question during this intermeeting period and certainly at our next meeting.